Earlier this year, I think we were 110 or 120 to 1, and the ratios come down. And I think a fair ratio is probably 20 to 1. I mean, you've got some people running around saying that because of the lack of above ground supply, you could see silver and gold trading 1 to 1. So even to put it into plain English, even if the ratio fell to 40 to 1, that means silver outperformed gold on a purchasing power basis 2 to 1. So I think it's hands down, if you have the ability to store it, silver's going to be gold on rocket fuel.
As 2023 began, the ratio was about 76. While not at an extreme, it's still 24% above its 55-year average. Goehring Rozencwajg Associates forecast gold prices to increase in the long term and lead silver, but expect silver to surpass it, and the ratio to hit 20, the near-low gold-silver ratio of 1980. Historically, silver has tended to lag gold early in precious metals bull markets. However, once silver kicks into gear, it massively outperforms gold in the middle and later stages. For example, from 1970 to 1980, as precious metals boomed, gold gained over 2,500%. Meanwhile, silver skyrocketed, gaining close to 6,000% in that decade. BillHolter, a precious metals broker, predicts silver will outperform gold if the ratio drops to 40. 1. Emphasizing purchasing power. He highlights a substantial ratio expansion in the 1970s and 1980s, reaching 110 or 120 to 1 in recent decades. Gold went on a run late last week, setting a record high last Friday and breaking the $2,100 level for a brief time in overseas trading Sunday night. Silver also rallied but continues to lag behind gold. For example, in April 2020, the ratio hit a record high of 127. By August 2020, just 4 months later, it had plunged to 72, a huge swing signaling a major repricing of the two metals. Holter advises against waiting for ideal entry points due to uncertain pricing in precious metals and warns of potential risks to bank balances during a crisis. Tightening monetary policy negatively affects the value of long-term assets on bank balance sheets, potentially causing instability as asset values decline relative to liabilities. Regarding precious metals allocation, BillHolter highlights the stability of gold and silver over vulnerable paper assets. Now, we present the clips of BillHolter's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The ratio of 82 to 1, it takes 82 ounces of silver to buy 1 ounce of gold. It comes out of the ground at 10 or 11 to 1. And I mean, for hundreds of years, the ratio was 15 or 16 to 1. And I've explained this, and I mean, I don't have proof for this, but it just makes common sense. If you go back 200-300 years ago, everything was done by horseback or carriage or mule or what have you. And in order to transport physically the same amount of capital in gold versus silver, you had to haul 10 times more silver. So what they did was they discounted silver down to 15 or 16 to 1, and that ratio held for hundreds and hundreds of years. Then we got into the 1970s, 1980s, and the ratio started to expand, and now we've gotten, earlier this year, I think we were 110 or 120 to 1, and the ratios come down. And I think a fair ratio is probably 20 to 1. I mean, you've got some people running around saying that because of the lack of above ground supply, you could see silver and gold trading 1 to 1. Even to put it into plain English, even if the ratio fell to 40 to 1, that means silver outperformed gold on a purchasing power basis 2 to 1. So I think it's hands down, if you have the ability to store it, silver's going to be gold on rocket fuel. Into the 50s, low 50s, you might want to do a quarter. My recommendation is that people be at least 70-30 silver to gold right now, looking to get to 70-30 gold to silver ultimately. And if you scale in the low 50s and then say 40 again, you scale some in. And then, if we got to 30 or under 30, you might be done with it and do your final batch, and you'll end up with more gold ounces than if you just bought it outright today. The other possibility for the question, at what price am I looking to scale in? I would just say that if you're waiting to get lower prices, good luck. I mean, that's not even something I want to discuss, because nobody's smart enough to know when this thing is going to come down. And when it does, if you're sitting with bank balances waiting to buy gold and silver, A, you're not going to be able to get gold or silver, and B, your bank balance is going to be bailed in. So when people ask me, how much should I put into gold or silver? My standard answer for 5 years now has been whatever you don't want to lose, because gold and silver cannot bankrupt, and every single paper asset that you have can either bankrupt or be taken. And I know you want to talk about the great taking later on in this, and the laws are already in place. I think that's absolutely the plan.
BillHolter highlights a noteworthy development: the United Arab Emirates' rejection of dollars for oil, signaling a change in OPEC's position. According to reports, the UAE is in talks with 15 countries and is promoting local currency payments, ending reliance on the US dollar. The realigning of bilateral strategic partnerships could lead to a paradigm shift in the financial approach of BRICS countries. Meanwhile, he raises the alarm about the banking system, citing significant unrealized losses, almost representing 50% of equity. U.S. banks have a ticking time bomb sitting on their balance sheets to the collective tune of at least $650 billion, but it will likely be diffused rather than explode. The banking sector, which has been rocked by 5 bank failures this year, has to grapple with the ramifications of buying trillions of dollars worth of low-yielding treasury bonds before starting the Fed's aggressive interest rate hiking cycle. Let's get back to the interview.
Where the rest of the world will bring the price, I can tell you that LBMA and COMEX will become completely irrelevant. Whatever pricing there is on COMEX or LBMA, it doesn't matter. And we're getting close to that, because if you look at the premium now in China versus the COMEX, I think it's $30 or $40. So there's arbitrage going on, which means supply is being bought off of COMEX and being sold into China. And how long can that go on? And there's one other thing, that this is not gold related, it's dollar related. We know that there's going to be 7 new BRICS nations in January, 3 really important nations: Saudi Arabia, Iran, and United Arab Emirates. And this came out, I think, on Friday. Only seen one news article on it. The United Arab Emirates is refusing to accept dollars for oil. So if you remember, a year or 2 years ago, Saudi Arabia was still saying, no, we'll only take dollars for oil. And then they changed and they said, no, we'll take other currencies. The UAE is now the first OPEC nation to say, we will not accept dollars for oil. If they were to come out and say, we will not, if OPEC as a whole said, we will not accept dollars for oil, guess what? The world, your world, our world, the Western world just blew up. I would just point you to the numbers, the graph that just came out earlier this week, that the banking system's got $600 or $700 billion of unrealized losses, which represents about 50% of equity in the banking system. And okay, they're unrealized losses, but if these banks need the capital and they need it right now today for some type of a capital shortfall, then they're forced to sell. Then those unrealized losses are actually realized losses. Back in 2020, I think they allowed banks to go on a no reserve requirement. So, I mean, you're looking at a completely over-leveraged banking system. The equity is getting eaten up with losses already, and these are supposedly good times. So what happens when bad times hit? And bad times, of course, could be like tomorrow morning if they flip a light switch. The banking system is precarious. We'll just put it that way. Any number of things could tip the whole system over.
Once the gold-silver ratio drops under 80 and silver gets moving, the potential for silver to quickly rise above critical technical and psychological levels at $25, $27, $30, and beyond. Above $25, silver will start to gain upside momentum, while moving above $30 is likely to accelerate gains as silver transitions into full bull market mode. How do you envision the future trajectory for both gold and silver in the coming months and years? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.